Millions of trees are being mown down to publish learned analysis of the Greek crisis, but there is far more heat than light. No one knows whether Greece will make its €1.5 billion repayment to the IMF tonight, and even fewer know what will happen if it doesn't, which it probably won't. But uncertainty is anathema to markets, so they all fell quite a lot in Europe and America last night. Wall Street was down 2%, and there was an especially big drop in Italy. But the punters in China saw some bargains after 2 days of big falls there, so there was a 4% bounce in Shanghai. The Greek banks remain closed after the European Central Bank stopped giving them money under the Emergency Liquidity Assistance Program. Now here's a graph showing the Greek bank run, which is the orange line of bank deposits, and the purple line is the cash that's been provided by the ECB for the Greeks to take out of their banks. About €100 billion, which basically constitutes a massive extra bailout, mainly from Germany. It explains why the Greeks will probably vote yes in Sunday's referendum, so that German cash can start flowing again. And here's why Greece is in more of a mess than the rest of Europe. The graph shows GDP of all the European countries, rebased to 2008, which is the GFC. Now, the worst of them, at the bottom of that spaghetti at the top, is Italy, apart from Greece, of course, whose economy has shrunk by 10%. Greece's output is down 25%, a savage depression with a capital D. And by the way, it's not just Greece that's broke, Puerto Rico is too. It's in the hole for $72 billion, and the governor announced last night that it can't pay that back. The Australian share market recovered a bit today with buying of banks and industrials. Retailer Kathmandu jumped 25% on receipt of a takeover offer from New Zealand, and Slater and Gordon had another bad day. And the Australian dollar was basically steady today, up slightly against the US dollar. And that's finance.